This is Martin here from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at technical charts and try to understand what happened in the market during the previous week and then also plan for a better trade for the upcoming week that's starting from tomorrow, Jan 13th, Monday, 2025. Let's get started. So, this is a bird's eye view, the weekly charts that you see for the Nifty. On the right side, you have the daily charts, and what you see here is a wide range, two parallel channels. So it's almost a parallel channel, two trend lines, and market needs to have taken a supported moving average, and still some more space left towards the bottom of the trend line to be breached. On the daily charts right side, you see that an attempted inverter had a shallow failed, and now it has reached the bottom of the parallel channel. What you see here, and it's a very crucial support. Banknifty, the narrowing ascending wedge has breached and it has fallen down from there, clearly visible with the wide range bearish candle, and the daily on the Banknifty is also at bottom breach of the parallel channel. So it's a very crucial levels. So basically what has happened is market has cracked down nearly 2.4%, that's 575 points down. 200 exponential moving average is breached. 20's exponential is no longer relevant, so the correction is extended to 11.5 and 11% on the Nifty, nearly on both indices. If you look at Banknifty had made bigger fall of 4.4%, that's 2,258 just in a week. So Banknifty has cracked down the most, and you can see the candlestick here, wide range bearish candle on the Nifty, very wide range bearish candle on the Friday, breaching all the supports that it was holding till then on Banknifty. Also you see that it was that's a weekly that we had seen here, right? Wide range bearish almost engulfing the previous candle, although the weakest outside that. So very strong bearishness is what the candlesticks are projecting. On the daily candlesticks you can see that it was falling almost all the days except for one day of consolidation of inside, but trying to kind of consolidate for just one day. That's it up to that. So otherwise it was big fall down, and same with Banknifty. Every single day except for the Tuesday, all days it was falling down with heavy bearishness in the market, what we see in the last day, no doubt about that. And multi bands are showing that it's expanding on the downside with bearish bands below the 20 exponential moving average on the left side Nifty and right side Banknifty, expanding downside, indicating more for the donor. But remember that the more it is away from the moving average or the median, more likelihood that it can come back the further it is. So Banknifty in that case has fallen too much away from the 20 moving average. So just to wrap up, we have wide bearish candlesticks. We have broken the major supports. 200 exponential moving average support is also gone. Now we're at a crucial support zone where anything could happen. From here, if it falls, it reaches the parallel trend line, and the fall can be even more sharper. The bearishness could turn, could intensify further, is what indicates. That's what the Bollinger Bands are also indicating. Let's move ahead. So whenever there is heavy bearishness or bullishness on one side, it's very much evident. It's easier to do the analysis, right? Because chances are shouting at you and telling that it's bearish or it is bullish, right? So when it is sideways where the analysis becomes tougher. But now bearishness is very evident. With respect to the momentum, also we can see that the weekly on the left side, Nifty and Banknifty, both are still sideways. It does not breach fall into the bear zones on the weekly or the medium term charts. Make note of that. But short term, it has fallen to bearishness on both indices. This is a summary of the momentum, right? Bearishness, sideways falling is what the trend is in the medium term with respect to the momentum. But with respect to the trend indicator ADX that we are seeing for the momentum, we are seeing the other side for ADX. It's DMI negative zones on both time frames and both indices. Absolute bearish trend, no doubt about that. Then you have the India VIX, which has fallen, which has spiked up 10% when the market went volatile and cracked down. So actually it moved up to 10%, settled to 10% week-to-week basis for India VIX. So it is now getting to the medium volatility range. So you have to stay double alert. When the VIX is rising, that means there is panic or some fear in the market. That's evident. Moving ahead, if you try to understand the uptrend analysis for the futures, it's short build-up. For the uptrend for the weekly and the monthly for the Banknifty. For the weekly on the Nifty and the monthly Banknifty, January 30th monthly Banknifty and January 16th weekly, you can see that this year is bearish. 0.55 is bearish, 0.73 also is bearish. So bearishness is what is heavily projecting on the open interest charts as well as open interest futures data. By using the open interest also, we can try to understand the support and resistance levels. 22,000 and 24,500 is where the highest put and call writing is seen. In 22,500 and 24,000, the second highest put and call writing is seen. 46,000 and 50,000, very wide range, very volatile wide range is what highest put and call writing and support resistance is seen. 49,000 and 54,000 is where the second highest put and call writing and support resistance is seen, right? So that's about it. A very wide range indicates very high probability of market being volatile, and 4,000, it's like the range between for the Banknifty is 6,000 points, and for Nifty it is 2,500 points. That's the big spikes up this range that's seen in the options OI is also wide, and so there's no doubt about it. These are the levels that we can look for. Banknifty, it can fall as low as 46,000, and for Nifty it can fall as low as 22,000 for the next week is what it projects. As of now, but this data has 4 more trading days left for Nifty weekly expiry, and then almost a month left for the Banknifty. So keep that in mind. These are all factors that keeps on changing every day, so keep close watch. But the resistance support levels can also be seen from the charts here. Right? We have a parallel channel there. Just a lot of space more to fall down up to 22,500 at least, and you can see that it's a very strong support zone of that another parallel channel that's marked red. So basically we find the levels based on options OI and futures OI. Also we use the technical charts like this to understand. So it's the exponential moving average, Fibonacci levels, previous resistances, previous swing lows, gaps, and all this which is used to understand where the resistance and the support will be. Right now it's very much evident would be the levels to look out would be 23,650 where 200 exponential moving average is there, then 23,850 where the 20 exponential moving average is there, and 24,000 is the major resistance, and after that it will be 24,100, 24,200 and 24,350. These are the places where the previous resistance, Fibonacci or the moving average 150, 20, 200, all these are placed at right. So suppose the range of this could be the Fibonacci 61 level that's coming at 23,154. 23,000 would also be good support because it's a rounding number. After that 22,800 and then 22,526 is all previous resistance zone from where the market has blocked out that could act as supports on downside. So 22,000 rounding number, and after that it goes to 21,825. It's levels on the Nifty that's marked in here. You can note up this, try to understand. Banknifty, there's a parallel channel, it's a very good support zones at 48,850. Bridge of that will take it to 48,000 only number first, and then 47,500, and then 46,900, 47 or 47,000 for the previous swing lows, and after that 46,574. Similar upsides will face resistance at 200, 20, 100, and 2. And 50 exponential moving average, that's at 50,300, 58,45, 51,200, 51,400. Those are the resistance that's marked here. Those lows are written here. Make a note of these and understand that. Right, so let's move ahead and see how different sectoral indices performed. Only the IT did well. It is very defensive stock, and pharma is also defensive, but pharma went down. So only IT that performed last week. All the sectors have cranked down. Look at what reality has lost nearly 8%, FMCG 1.2%, pharma 3.8%, auto 4.2%, 5.5%. So all of them have either sideways or bearish momentums on the medium term. So wait for any long positions, short positions you can play for swing, but overall this analysis indicate if it is ready to go long or not, basically. Right, so challenges except the ID are all in trouble, and ID also it is not fully ready to take long positions because it is still sideways from the weekly on the short term. Short term does not climb back to the bull zones yet. So you can see all those charts in detail here. Right, IT index clearly shows it has taken retracement and then but maintaining the bullishness on the momentum RSI about 60. Sorry, and the downside metal has fallen to the bottom support zones, so it could be a reversal can come in potentially, and auto is done a really decent retracement that consolidating in the medium term. Pharma also at the bottom of that parallel channel, so reversals can be there. So basically pharma has defensive, it has slightly slipped to the sideways. Just last Friday's big fall. FMCG is also retraced substantially and it's a deficit strong. It's also at the bottom, so it can reverse. So FMCG, pharma, metal, and auto could bounce up from here because they are retraced correct substantially. Realty is making a big nosedive. It's in a flat pattern, so it slipped to the sideways after nothing but a move up previous weeks. That's about it. Now, if you try to understand the industry heavyweights, contribute backs, HFC Bank, the biggest contributors, one plus sideways with the wide range bearish candle. It had failed to maintain 1,850 above levels. It's hit the top of the panel channel and fallen down big volumes. Cross over of the trend indicator or ADX and then sideways momentum falling. So what is your lens? The biggest contribution to the Nifty sponsor lens and still remains in bearish and resisting below the 40. Heavy bearishness, the small space to go down. HFC Bank, the big bullish player, is now retracing and then going down towards the parallel channel. Momentum slip to the sideways. So, these stocks are done well with the green candle. The only green candles that you can see in the thesis and these, but momentum is still sideways. Kodak Bank, as usual, calls a bet sideways always. IDC is also sideways playing. So, major players are either sideways or fallen to their zones. Is what the industry heavyweights are showing. So, stay out. The broader markets, mid cap and small cap, both have showing big wide red candles, taking them deep into the sideways, but still not made into bearish yet. Right? So, still in that 15% kind of correction. So, still the bottom of the channel. Subsequent support any breach from here could mean that the market also corrects substantially. So, that's the bottom markets. Not doing good as of now, but still not that bad in the medium term. Institutional participation, if you see, interestingly, DIs have been buying heavily, but FIs continue to sell, and retailers followed the FIs and then went very bearish last week. And net longs have gone down, actually, if you see, on the derivatives with respect to the DIs. And so, participation of the FIs is very worrisome, but DIs are giving their full to keep the markets stay afloat. Now, if you try to understand the global markets, the currencies and commodities and all that, let's start with the dollar. Dollar is breaking out following the president rule that's coming end of the month, and it's 0.63 up, and that's bullish rising momentum, which is not good for the emerging market like ours. Rupee has found even more weaker, and US INR is 0.48% up, 86.15. That's really bad. Crude oil is breaking out. That's another trouble. For oil importing country like ours, it's breaking out of the channel. It's about 76 now. Gold is breaking out once again after consolidating for several weeks and trying to make all-time high. The market is crashing. Gold is rising up. It probably gives indication that money is shifted from equity to the gold. Safer bet. That's so. How long? Commodities, crude oil, gold are not showing a good picture for the equity, and dollar and currency is also very encouraging. US markets are showing red, deep red on both, and it's found to sideways and falling down. Right, so it hit the all-time highs just 4-5 weeks before when the US election vote complete, but now it's falling and correcting, and same is reflecting on the market as well. There's no contradictions there. That's it about the analysis. To take it in a nutshell, you can see that the commodities like crude is rising up. It's not that great. Gold shooting up is not very good news for the equity market, and although it's a hedging instrument, if you hedge the gold, then it's good news, but otherwise not that great news. It usually rises up when the equity market is falling. And US market's in trouble, that's some other market is trouble, that's a nutshell. So let's stop the analysis and do some action. Two short trade opportunities, HDFC Life Insurance. One is to RiskReward trade because momentum is to the bear zones in the medium term. Trend also is close to the bear zones, big volumes, parallel channel has a lot of space from downside. So one is to RiskReward trade opportunity swing is here on HDFC Life Insurance. Sriram Finance is also a head and shoulder breakdown, so already happened. Another one is to 1.5 could come in if it doesn't find support at RSI 40. It could be a breach and then it could be built fall to the 444 levels. It could go as well as that. Right, considering the height of the head and shoulder breakdown. So that's two short trades, Sriram Finance and HDFC Life Insurance. This is an FNO strategy. That's a ratio spread, call ratio spread, where you're selling the call OTM call and further OTM call is selling, and then OTM calls here buying, but the selling is twice as that of the buying. So it's not completely risk defined. If market shoots up, reverses, and then goes above 24,000, you'll have trouble. As soon as that does not happen, if it consolidates or falls in the negative zones, it's fine. Right? It's fine. So that's what it says. Yeah, that's call ratio spread. So exit if it's exiting 24,000 immediately. No more adjustment. So let's finish that in the Nifty weekly call ratio spread. Let's just wrap it up. Market cranked down, falling further down from last week, where it showed some indication of a pause, but it didn't happen, and it closed negative. Banknifty has fallen big time, more than 4%, while Nifty has fallen more than 2%. So correction is extended to 11 plus on both indices now. And if I continue to sell, not good news. Remember, we had a very big rally of 72%, and this 11% is nothing. But decent corrections come in. Market could find some support, or it could break down and make major corrections of 10 to 15% or 15%. It could head towards that, because decent corrections extending to 15% is not yet happened. It's very decent, I mean, right? 11%, 11.5%, 12% is decent, but you don't have to worry if it goes to 15% also. So it could happen, because we had a very big, very long bullish rally. That is, so expect that. If you try to bucket the things that is different parameters that is in favor of the bulls and the bears, very few things in favor of the bulls, it's all in favor of the bears basically. But the momentum is still not slipped in the medium term with the charts into the bear zones yet on both the indices. The positive thing is still sideways. So in favor of the bears, FIs, they're selling spree. US market is red, deep red. The momentum slipping sideways, and now open interest is showing bearishness. PCR futures are everything. Candlesticks are heavily bearish, lower high price action. And Bollinger Bands are downside expanding, bearish bands. Sector indices, heavyweights are all in the sideways or falling down. We've seen that. And Reliance is major heavyweights of this bear zones and not ready to rise up. And markets are below the 200 exponential moving average means nothing much need to understand. It simply is bearish on the short term at least. Technically, market is bearish biased, and therefore have a moderate bearish biased view for the next week as per the charts. But market could find support and then consolidate. Right? It may consolidate for a week and then fail to consolidate and then break down. All this could happen, but the charts are shouting at me that it's moderately bearish bias. So levels to look at for the next week is 22,000 to 24,500. Good swing either way. It could be a reversal gap or going to be breach of the current levels. 46,000 and 52,000 is the very wide range of 6,000 points that I see for the Banknifty. So until this 26,000 and 54,000 in the Banknifty is clear, we're still consolidating or the correcting. That's what it's as always. More about the technical analysis, go for a toss if there is any black swan events like the pandemics or election, recession, rate cuts, and all this comes in. Black swans could come in any time. That will negate the technicals, right? But technicals gives you a probability of where the resistance could come in and the probability where supports could come in. That's all it is all about. So always hedge your positions, hedge your portfolio, and take the losses early and then get out if your plans go wrong by any way. Check out the hedging strategies videos that's in the playlist, and you can find a lot of them. Strategies. And in case you like the content, subscribe, like, comment, feedbacks and all that you can put in. I'm also actually in Twitter, and you can subscribe to that as well for daily charts and analysis are posted there. Apart from this weekly analysis, that's all I have. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.